We'll go ahead and get started. Welcome everyone to a webinar hosted by Ascent CFO Solutions, Bigfoot Capital, and Massive. The topic is scale your SaaS, tracking the right metrics to impress your investors and gain trust. So a few housekeeping items. We are going to be recording today's podcast, so we can share this with folks who were not able to attend live or people who want to watch again. We'll be sharing some things for the first 45 minutes, and then the last 15 minutes, we will take questions and have an interactive Q&A portion. Anytime you like, feel free to ask questions with the Q&A button at the bottom of the screen. And if we're not able to get to your question, we will share contact information. We're happy to talk to anyone directly if you want to just reach out to us. All right, so these are your three panelists for today. So my name is Dan DeGolier. I'm the founder of Ascent CFO Solutions. We're a fractional CFO firm here with offices in Boulder and Denver, Colorado. Started the firm back in 2011 and started growing it starting in 2015 pretty substantially. And we serve companies across lots of industries, and SaaS companies are one of our industries that we provide a lot of support for clients with everything from fundraising to financial modeling, cash flow forecasting, exit planning, things like that. We have a full stack of professionals from CFO to controller to accounting manager to senior accountant, and also lean pretty heavily into data visualizations with our Insights solution, and have a team of financial analysts for that as well. Brian?
Yeah, hey, Brian Parks, Bigfoot Capital. Thanks for having us, Dan. Bigfoot Capital is a lender to B2B software companies, predominantly software as a service, SaaS businesses, but we also work with some B2B marketplaces, more transactional business models, and tech-enabled services businesses. We've been doing that for about 7.5 years. Have worked with over 50 companies and provided about $85 million of non-dilutive debt capital to those businesses to support them in their growth journey. And we take a very metrics-driven approach to our underwriting when we're evaluating companies, and then in our ongoing monitoring as we're kind of once we've invested in those businesses. So metrics are very important to us. Prior to Bigfoot, my career was kind of as an operator in earlier stage software businesses, to include SaaS companies, and prior to that, investment banking, doing middle market M&A.
Hey everybody, David Mandel. I'm one of the co-founders and managing directors at Massive Venture Capital. We are a multi-stage national investor, but based here in Boulder, Colorado. We invest in B2B SaaS, fintech, deep tech, and climate tech companies once they pass the seed stage. So we do not do any super early investment in pre-seed, angel, or seed. We like to see about $1 million or so in revenue before we get involved, but then we invest along the entire business lifecycle, multi-stage, all the way up to exit. Prior to starting Massive, I was a multi-time founder myself, so I've started and sold 3 different companies before becoming a full-time as co-founder. So we're really operators and CEOs and founders at heart. We understand what it is to run a business. And we like engaging that experience and those skills to not only find the best companies, but also support them through growth. Obviously, from a SaaS perspective, we see many business pitches on a weekly basis. We've gotten fairly good at pattern recognition around who understands their business well, who's talking about the metrics the right way, who's selling their company the right way, and most importantly, who's providing confidence to investors that they are the people in the company to bet on. So certainly leaning into a lot of that experience and pattern recognition in the discussion today. I'm super excited to be here.
Awesome. Well, thanks guys so much for being here. I really appreciate you taking some time out of your day to join us here. Here's the agenda of what we're going to cover today. Again, things are around SaaS and growth targets. We're going to talk about the things that you should be tracking, what various investors might want to be looking at. The key is to really know your numbers, right? I think the biggest takeaway, the biggest message we want to get across is that you as founders and CEOs and management teams really need to understand your numbers. You need to recognize, identify what your business's KPIs are, have very clear targets for those growth metrics, and then have a clear way to track against those targets and know that you're tracking or not tracking. Some standard KPIs and metrics that SaaS companies are going to be familiar with. Your monthly recurring revenue and your annual recurring revenue, pretty self-explanatory. Customer acquisition costs, it's good to have a good handle on that. Your churn rate, those are the clients that you're losing during the year. Your net retention, of course, is you identify a cohort as a point in time, and then you want to see growth within that overcomes your churn. You want to see that your additional revenue coming from that cohort exceeds your the churn that you experience. David, do you want to talk about Rule of 40 and some of the other ones?
Sure. Yeah. I mean, there's a lot of industry terms that have gotten thrown around over the past 10 or 15 years around growing SaaS companies. The Rule of 40 is one of them. That was actually, I think, coined by Brad Feld in 2015. It's a way to understand how to monitor the appropriate growth of a SaaS company. And it's fairly simple. It basically means if you add your annual revenue growth rate to your margin, it should equal 40, right? So obviously there's a lot of wiggle room between increasing growth and decreasing margin, increasing margin, decreasing growth. But it was basically a measure that a lot of people in the industry have been using to look at the health of the growth of a SaaS company moving forward. There's another term called T2D3, which was, I think it was, that's right, Niraj from Battery Ventures, he talked about T2D3, which basically means you should, as an early growth SaaS company, if you want to have a very clear path to becoming $1 billion business, the most optimal way to do that, and the metrics that a lot of investors were looking for were tripling growth for 2 years and then doubling for the following 3 years, right? And that was a pretty well-established metric for, is this SaaS company on track to become $1 billion business over time? In essence, can I get from 1 million in revenue to 100 million in revenue in a 5 to 6 year period, and as a result have a valuation of around $1 billion, which was a unicorn back then. I think the keys to remember around a lot of these terms were coined during a very aggressive bull market, right? And so a lot of the measures that and terms that you hear in the past were used to look at companies in a market where capital was fairly easily accessible. It was really about speed of growth and which winners can we bet on the quickest to become $1 billion company, right? And get some exit from a venture perspective. So they are simply terms. They are not hardcore measures that I think anyone needs to stick to, but it's always helpful when you're running a SaaS company to understand what the industry is looking for, understand the terms, be able to talk to them in comparison to where your company is. Because at the end of the day, it's really about instilling confidence in the investor's mind. And the best way to instill confidence is to know what you're talking about. So if these terms do get thrown around, you should be able to answer around where your company is in relation to that. Obviously, early stage, a lot of this stuff is irrelevant, right? More of this is kind of early growth, mid-growth stage terms. But the key is you should know them. Because as the CEO and as the leader of the company, it's your job to know all the things about your business and surrounding it so that when you're talking to potential investors or debt providers, they're like, oh, this person knows this business. And I'm feeling a sense of comfort, and makes it much easier to get to a decision to either invest or loan or et cetera. So lots of terms to be thrown around, but just know what they are.
100%. Do you want to talk a little bit about capital efficiency, Brian?
Yeah, I was going to get to that. So, on the previous slide, those last three, are kind of capital efficiency oriented. So a few ways at Bigfoot Capital, we always say, hey, we're happy to provide growth capital. Oftentimes that growth capital is funding burn, hiring, these companies aren't consistently or materially cash flow positive when we enter them. And oftentimes for the life of our relationship, they're not. However, we're not an endless well of capital, and nor do we want to work with companies that require endless wells of capital. So at some point, you need to show some efficiency in your business model. So, you take Rule of 40 as an example. As David mentioned, we've been in a pretty bull hyper growth, venture and startup market for a number of years that, now we're not in anymore and haven't been in for a couple of years. And I don't know when we'll be in it again. I'm sure we will, because all things are cyclical. But, it may have been the case that you could get to Rule of 40 with, 100% growth and negative 60% free cash flow margin. That's a lot less appealing to many investors out there these days. It still appeals to some, but maybe it's a Rule of 40 that is 40% growth and break even. I think that's very appealing to a lot of investors in this market. So even just within that one metric, there's been a big shift in terms of what is considered investable and healthy. Burn multiple is another one. This one was coined by David Sachs with Matrix Partners. And it's basically looking at, okay, growth at all cost is not really a thing people are interested in anymore. Everyone is still interested in growth, but everyone understands that it's gotten a lot harder to grow and, possibly more expensive to grow, frankly, just given the number of software companies out there. So burn multiples is saying, all right, how much are you burning? What's your net burn divided by your net new ARR? So we want you adding net ARR, but we also want you doing it with some level of efficiency. So, like the ideal there is it's lower than 1. Your burn over your net new ARR is less than 1. That's like really, really, really good. I think if you're less than 3, you're like, pretty decent. Above that, it's kind of like, look, pumping money into this growth engine doesn't really make sense. It's not a value accretive thing. Another way to look at capital efficiency, one of the ways we look at it, which is important to us, is how much money have you raised life to date and where are you from a run rate standpoint? So if you're, again, kind of less than 2.5 to 1, that's okay. If you're 1 to 1, if you're a $5 million ARR business that's raised $5 million, that's pretty damn good. There's a lot of $5 million ARR businesses out there that have raised $50 million. That's not as good, 10 to 1. So that's an important one. And it's important not only looking back, but looking forward. If you're a 1-to-1 company, we have probably a lot more confidence that you're going to continue to be able to be a 1-to-1 company or not need to raise as much capital going forward on your growth plan. If you've been 10 to 1, you've raised 50 million and you're at 5, it's going to be a lot harder to believe and a lot harder to reorient that business to something a lot more capital efficient.
Yeah, I think you guys both commented on the fact that the fundraising environment has changed over the last 18 or 24 months. And I think that's important to understand that we are not in this phase of irrational exuberance like we were for a number of years. And I agree, all things are cyclical. We have no idea how long we're going to be in this sort of tighten the belt sort of mode and preservation of capital mode. Growth is still important and deals are still getting done. But we're back in that cycle of people are doing more diligence and valuations are getting more scrutiny and business plans are getting more scrutiny, which I personally think is healthy.
Yeah, it's very healthy. Actually, I think it's very healthy, and I think it's actually a really interesting conversation with me and Brian because we're coming at it from different perspectives, right? One's we're an equity investor looking for liquidity and growth. Brian's a debt provider, so he's looking for capital efficiency to make sure capital gets paid back over time. And so a lot of the things that Brian was mentioning around capital efficiency, they're obviously all important, right? And any investor, whether it's debt or equity, is going to be looking at where are you on the capital efficiency side. I think one of the big things that we've seen over the past year or two, especially with a lot of the pitches and companies we've been talking to, is a lot of them are talking about, can they get to break even and get to profitability, right? And profitability is kind of the new golden stage that we're seeing because capital is not efficient anymore and it's expensive and raising capital is hard, a lot harder than it used to be. And I think the important thing to remember from the venture investor perspective is we're not really worried about profitability, right? If we're looking to make new investments, profitability is not our goal, right? What we want to see is growth and exit value. And a lot of the pitches we're seeing, especially from SaaS companies now, are showing us, oh, we're going to get profitable. I'm like, okay, that's good for you, but that's not really what I'm looking for. I'm looking for a big potential growth company that's going to give me a big liquidity event and add a big multiple on my investment. right?
Market
And
share disruption, it's a different sort of model. So I think I intentionally brought you guys both to this just because you have such different perspectives, right? And so I think it's important for the audience to understand that it's really critical to know your audience. Who are you? What is your long-term capital plan, and what are your partners going to look like in that sort of trajectory?
Yeah, and likewise, it's important for myself as a debt provider to know David's perspective, and vice versa. A lot of the companies that we lend money to are venture backed, or they may be trying to become venture backed, which may ultimately pay us off, or we may provide more capital at that point in time. So it's very important for the market participants from a capital standpoint to understand what game they're playing and what the expectations are. If I've got a company growing 20%, but it's highly cash flow positive, maybe that's fine. It's gonna be of zero interest to David. If I've got one growing 100%, that's burning some cash, he may be very interested in that, right?
Yep, I think
Exactly.
again, I think we both have similar perspectives because we've got the right experience. We're looking for different metrics, right, and key indicators when we're deciding on making an investment. So,
yep. Well, let's go to the next slide because that's kind of exactly what we're talking about here. So, I think I'd love to hear both of your perspectives on sort of what are the targets that you're looking at today. What are your targets from a growth expectation, and what comes to the surface for you? What comes to the top for you?
do you want me to jump in? You want Brian to start? Where do you want to go?
Go for it, David.
Okay. So I think one of the keys that we're looking for from a venture perspective, and I'm going to start kind of a generalist high view on this, is someone that understands how to tweak the levers of the metrics to the business, right? So how do I understand what the key drivers of my growth are? Do I understand what the costs of those drivers are? Do I understand what my levers on capital efficiency are? And can I make intelligent decisions around an appropriate growth rate to drive my business into a 30-40% ARR growth rate over 2 to 3 years, right? Because remember, as an investor, that's not a super late stage investor, right? We're not just talking about late stage pre-IPO investments here. We're talking about growth investments. What I want to see is if I give you a check, I want to know that as the CEO of that company, you understand the levers of your business well enough to be able to take the money I give you and over the next 18 to 24 months, make that company worth a lot more money. Right. And it's kind of a very simple equation, right? Because I want to know that you're going to use my capital efficiently to not just run your business, but to grow your business. Because what I want is I want the valuation of your company to increase significantly over that 18 to 24 months. So either you're getting closer to potential acquisition or exit value, or if you're going to raise another round, the money I gave you today is going to be worth 3 to 4 times that based on valuation when you raise the next round.
Yeah, that's the step function, right? You've hit milestones. You now have substantially increased the size of your business, the growth of your business. It's more appealing, and so that next lead investor is going to be enticed to jump in.
Yeah, exactly. And so it's really how do you adjust the levers within your stack of metrics to make decisions around the right way to grow your business. I will tell you a couple of things that we look for pretty specifically, or that like set some companies apart from others, right? Especially if you're like an enterprise SaaS model, right? One of the things we look at is net negative retention, right? So, or net negative churn, right? And so we talk about churn. How many customers are you losing over the course of a year, or whatever the cohort measurement is? One of the things that we like to see is net negative churn. So in essence, if you have a SaaS company that's getting into an enterprise client, are you increasing the value, the average contract value of that customer over time, right? So if you get one team using it, does it expand over other teams? Right. So your cost of acquisition over your lifetime value goes down significantly, and your ratio is going up tremendously, right? And that's an efficient growth engine for a SaaS business. Or what's your cost of production on your sales reps, right? How are you selling, right? Are your sales reps providing positive return on your investment as you hire them? So in essence, okay, look, if I'm 120, 150% out of each sales rep, if I just hire 10 more sales reps, I'm going to increase my business by X amount, right? And that's an easy formula to look at applying money towards.
Right.
what a lot of investors don't want to do, and certainly not us, is provide money for people to experiment with. Right. And that's what a lot of early stage, like super early pre-seed and really early seed investors are taking on. Hey, I have a lot of belief in the team. I think what you're doing is cool. I'm going to take a big risk that you're going to figure it out. Right. And they're going to index an industry and make tons of investments with that risk. And some of them are going to get huge and pay off. We have a very different approach because we're not early investors. We're going to provide capital to you as a company. You understand what your MRR is? Do you understand what your margin is? How are you going to drive your cost of acquisition and grow your annual contract value over time? And do you have a really tight story around how that's going to happen? And then what's going to happen next if we give you this money?
Right. That's back to the lines, not dots, right? You want to see that trajectory. You
All
want to
lines,
see
not dots. Yep,
yeah.
Exactly. So, we get a lot of questions from companies looking to raise like an A round or a B round, like, hey, where do I need to be at revenue wise to raise an A or raise a B? And my reply is always, that's the wrong question. It's not where do you need to be from a revenue perspective. It's what does your growth rate need to be? Right. Because again, like you said, it's lines, not dots. And are you showing me accelerated growth over time that's going to increase significantly if I provide additional capital? Right.
Yep.
It's not really, I just want to see, I want to see you at this revenue level. Like if you're just coming along, you're very, very slowly getting to that revenue number, I don't care. Right. But if at the beginning of the year, you were way below that revenue number, you're not quite there yet, but you're showing me a growth path that's going to double that number in another six months or 8 months, that is much more interesting to me because now I'm seeing a very aggressive growth line as opposed to just a dot.
Yep. That makes sense.
So I'll pause there. I'm going to go deeper on all of it. And
so
it wasn't KPI specific, but
yeah, no, that's really helpful and really valuable. Brian, you're going to have a pretty different perspective as far as from your standpoint. Again, the two of you are just you've got your own theses and your own approach and what you're looking for with debt and providing debt and equity. But I'd love to hear your perspective on these expectations and what kind of targets you're looking at.
Yeah, I think expectations growth. That was great, David. And David mentioned earlier, T2, D3, triple, double. That I've always thought of it as kind of like there's venture desired growth, there's venture accepted growth, and then there's venture achieved growth. And I think all of the venture desired growth maybe hasn't changed. Venture accepted and venture achieved have changed, especially venture achieved. And when I'm saying these things, I mean the companies within a venture capital portfolio. For venture achieved. And so within our portfolio, and we've seen that as well. If you kind of look at our portfolio in median, companies are growing. They're $5 million top line companies. We'll do $2 to $15 million revenue businesses, writing them $1 to $5 million checks. They're growing like 25 to 30% a year, which in and of itself is not bad. However, if they're burning a lot of cash, it is bad because then it's like, well, who's really going to get excited about that? Maybe some private equity players get excited. Maybe strategic acquirers get excited. VCs aren't really going to get excited about that. Now, they may have some companies in their portfolio that look exactly like that, but they're not that excited about that. So, but I think, the market of venture capitalists, private equity folks, non-bank lenders like us, bank lenders, everyone has, growth has gotten a lot harder to come by. And so expectations have to have changed. And they've come down. And so that's just the reality of it. It doesn't mean that that doesn't mean, however, as an operator that you're all of a sudden look a lot better because you're growing 30% than you did 2 years ago. I don't think that's necessarily the case. And, if you're really trying to raise venture capital again, you really need to just juice that growth rate back up. That's just the reality of it. But I think that given that degradation in growth, what has led to like, shoot, if the growth's not there, the profitability or cash flow has to be there, or this is just not a fundamentally good business. And that's been a startup in Paul Graham, Y Combinator's words, was an organization designed to grow fast, And I think that led to, you know, hyper growth and growth at all costs and a lot of unhealthy things, frankly. And
Right.
since I started Bigfoot Capital in the first place, I was like, wait a minute, there's all these B2B software companies out there, some subset of them, which really should be sub 5%, David, tell me if you agree, should be venture backed, right? And truly venture backable. What about all the other ones? Doesn't mean they're crappy businesses. It just means that maybe they should have a different capital structure and different expectations and different outcomes. And so I do think, you know, for what we do, all of this, you know, you got to find the quality, but all of this presents opportunity of like, you know, there's a lot of companies that were on a venture path that no longer are. There's a lot of founders that maybe ran a venture-backed company that say, oh gosh, I didn't know what I was getting into and I don't want to do it that way again, but I'm smart and experienced and I want to build software companies. But yeah, and then the communication of the metrics to investors, nothing's changed there. I just think it's even more important that you know how to communicate your metrics to investors in this market environment.
If I could jump in real quick before you get to, because I know you want to go a little deeper on how to communicate, which is super important, but what you said is really, really important, and it's worth kind of echoing around, you know, what should we be a venture-backed company, right? And do I really understand what my growth challenges are once I become a venture-backed company, right? And it's kind of funny to say, but as a venture investor, I spend a lot of time talking people out of raising venture capital. Because you know the truth is, once you raise venture capital, you are agreeing to a specific growth path for your business. That is not always easy, right? And so one of the things that I say is, if you really understand your metrics, which we're talking, you know, which is super critical, and you can plot out a path of how you want to grow your business. And that's really a personal decision, right? That's a leadership decision. That's a CEO's decision. Like, how do I want to grow this business? Then you have a lot of tools available to you to facilitate that growth, right? Whether they're customer revenue is your leverage, whether there's debt, whether there's venture, all of those are just tools to help you grow your business. It's your job as a CEO to decide which tools to deploy when and which tools fit best into my growth plans, right? And if you really understand your metrics and you understand the levers that you can pull to adjust each of those metrics, you can make those decisions. Because once you take venture capital, you are setting your company on a path that you no longer are in complete control over.
That's so true. That's so true. It is I have similar conversations with founders around the idea, like, okay, here's what you're signing up for. It can be an incredible tool, an incredible capital partner to be able to scale, but it is, you know, you're signing up forever a path of growth at all costs, swing for the fences. You know, it's not for everyone, and some companies, you know, might be better off waiting until they have a higher valuation, have proven out the model a little bit further, have proven that their ability to scale, and are now on a different level of growth. They're not just kind of early growth; they're kind of mid growth, and they're ready for that next level. And I think that's a really great point. You know,
happy to go deeper. Brian was saying, and I thought it was super important to reinforce.
Can folks here see the chat or the Q&A? Because I was going to drop something in there, something I ran across yesterday from a guy named Eric Paley at Founder Collective, a very successful venture capital firm. And it's great. I shared it with our team. I posted it on LinkedIn. So however we can share that with the audience. You know, one of the things he said, capital has no insights, right? Just because you raise it, it's not a panacea. It can be a detriment. It can be a tool. You know, you can have good partnership, but the capital in and of itself has no insights. So, you know, what you're trying to do, and Dave mentioned this earlier, is like, you know, if you had to experiment in these businesses to find levers and things that work, but you should try to do that in the least capital intensive way possible. Right. And then once you find something that works, that is creating real value and, you know, turning $1 into $5, great, then dump some cash into it, so long as it continues to work. But, you know, I think this, Dave, you said, you know, as a VC, I'm convincing people not to take VC. I think this thread from Eric Paley does some of that as well, and just kind of, you know, look, here's what all this means. Here are the laws of physics for startups. Here's how capital can impact these companies, good and bad. So I wanted to share that. I don't know.
That's awesome. I mean, think of that in an early, in those sort of experimental phases, maybe you're better off taking non-institute, if you can, raise friends and family or whatever that looks like to be able to experiment a few things. Again, try to get a little bit of a breakthrough, get to that next step of milestones before you sign up for institutional. I think for a lot of companies that makes a lot of sense. Reminder to folks, feel free to put more questions in the into the Q&A chat. We do have a question that's going to lead us to our next slide. How has VC funding changed and how people are looking at things, seed versus A versus Series B. Let's talk about kind of the current environment. If you want to go to the next slide. I think it really is, what is the current environment? We've talked about what it looked like in this very long, sort of bull market, high growth at all costs sort of phase that we've seen a couple of times, and I've seen a couple of times in my career. What's new? What is the new perspective from the various markets? So David, try to speak to not just Massive's perspective, which is kind of later growth, but like kind of what are they looking at, seed stage investors looking like versus A, things like that.
Yeah, so I mean, there's a lot going on, and I'll preface it by saying, I actually had a conversation with a founder about 3 or 4 months ago, who was trying to raise and had raised a bunch of money and was trying to raise another round and was incredibly frustrated and overwhelmed, and because it's super hard to raise right now, and he was visibly upset. And the question was, dude, like, when does this market get back to normal? Right? And I said, I actually think we're on a path to getting back to normal over the next 12 to 18 months. The difference is my perspective of normal is very different than your perspective of normal.
Mm-hmm.
Right? And just as an old dude, like having been through several market cycles in the 2000s, 2009, 2007, like I have seen cycles in the market. And one of the challenges is a lot of today's founders and CEOs have only grown up in a very aggressive bull market. And so the data they have is based on an anomaly. Right. And so understanding that perspective, I think, is super important. So when you talk about what's going on today, I think there's a couple of different dynamics going on today. The first dynamic, which is unfortunate, is you're seeing a lot of companies that raised money at very high valuations during the bull market that are now what we call ghost companies, or way over their skis, right? Because they're never going to get their revenue to the point where they can raise another round at a higher valuation. And that's a very, very scary place for a company to be. We are seeing a lot of Series A, Series C extensions going on right now. So raising money at the same value you raised money at 12 to 18 months ago. Or in worst cases, we're seeing a lot of down rounds, right? Where companies realize they're never going to be able to raise at an appropriate valuation given the market right now, and they're raising at lower valuations, which crushes all the existing investors down, and which is really a mess, right? If you can even get it to happen. So there's a lot of that going on for really good companies, and that's the problem, right? Some of these companies are really solid companies and they have great value prop and good revenue. The problem is they're just never going to be able to scale that revenue to the point where they can overcome the valuation hurdle they raised at 12 to 18 months ago. And that puts them in a very dangerous situation. So that's one of the things, and I'm happy to go deeper on any of these. I'm just trying to kind of categorize.
Yeah. So along those lines, real quick, I'm going to just interject with a quick question, because how often are you seeing sort of gamesmanship around that, where there's, it's a flat round, it's not a down round, but yet there's like warrant coverage, or there's something else in there that really is masking the fact that we're really looking at a down round. Is that something that is common, or do you think that's more of a unique exception?
I don't think it's common, but it happens, right? And that's the investor's job, to do the diligence and understand the cap table and understand the ownership structure and understand where the warrants are and what the real ownership of the company is.
Right.
And so it definitely happens. And there's a lot of debt providers that have warrants and ownerships like that, that everyone you have to look at as a new investor, and that it impacts the ownership and the valuation of the company significantly. So there's definitely a bunch of that going on. I wouldn't say it's common.
Okay,
but
good.
It's definitely happening.
Thank you for that. didn't mean to interrupt you if you have one.
Yeah, no, that's okay. So,
there.
so the next part of what I was going to say is the other thing that's happening in the market today from a venture perspective is investors do have capital to invest, right? Like there's funds that have capital that want to deploy. They're simply taking a lot more time and doing a lot more diligence to deploy that capital, right? So what they're looking at, very relevant to today's talk, is they're looking for companies that actually know their numbers, understand how they're going to grow their business, and have a really solid, intelligent story around the plateaus it takes to grow the business. And I talk about this a bunch. I very rarely see companies that just go up and to the right. Right, like these are perspectives that the industry has told us about, like, oh, the company, it's how quick are you going up and to the right, right? And it's never a smooth curve. It always happens in plateaus, right? And it's understanding how do I figure out the way to grow my company efficiently where I am right now? What's the next stage I need to get it to? What capital do I need to get it to that stage? And if I get it to that stage, what happens next? Right. So, early mid stage, do I understand how to get a customer? Right. Once I get that customer, can I keep that customer? It may be expensive for me to get that customer early, but at least I've understood how do I get that customer? Can I keep them? Can I grow that revenue? Next stage is, okay, how do I acquire them more efficiently? Right. And if I can start acquiring them more efficiently based on the numbers I know now I can actually have a company that's growing well. So
those trends matter. Those trends matter.
Trends absolutely matter. So what I'm backing into is if you can tell a very intelligent story around the growth strategy for your business based on these KPIs and which ones you're looking at when and how you're going to tweak them, there is capital out there. The challenge is the investors are going to take more time to due diligence. The valuations are much more reasonable, right? So you have to have better expectations around how much of your company you're going to sell, right? So a good way to think about that is pretty much every stage until growth stage, you're going to sell between 15 and 20% of your company, right? Because a good lead investor has ownership targets.
Yep.
And you got to know what kind of size check they're going to deploy, and they're going to write you a term sheet based on owning a certain percentage of your company for the check they're comfortable deploying.
And that's cumulative, right? I mean, the next round is going to be another 20%. Yeah.
So the deals are getting done, but they're happening much slower at much more appropriate valuations. And they're based on the CEO's ability to tell a very intelligent story around the growth strategy for the business based on solid metrics. Right? It's not just, hey, we're the next this and we're going to explode. You want in, you got to invest now, right? Like that just does not happen anymore. Right. And so because it's harder to raise, you have to optimize to tell the story, to optimize on the raise, you have to really understand your metrics, be able to tell a consistent story about how you're going to grow your business. And instead of optimizing for post-money valuation on a raise, what you should be optimizing for is a good partner that's going to be able to help you grow your business over time. Post-money valuation that puts you in a place where, based on my projected growth rate, understanding my KPIs and the strategy I have, what's an appropriate post-money valuation to end up now, so I'm not going to have a hard time raising the next round.
A lot of people have fallen into that trap, right?
It's a huge trap.
And now your post money is just not achievable with the current market environment.
And I said, like, this is the problem. Founders think that their post-money valuation is what their company's worth. And that couldn't be further from the truth. Your post-money valuation is exactly how deep a hole have you just dug. And the bigger the valuation, the bigger the hole that you have to get out of to be able to raise your next round.
You set the bar that high.
Exactly. Yep. So you have to be comfortable that based on my understanding of the metrics, what it's going to cost me to acquire people, what's my average contract value, what's my margin, how efficient am I deploying capital, where do I think I can get my company in the next 12, 18, 24 months from a revenue perspective to justify a valuation that's at least 2x what I'm closing now. And now you can grow your business efficiently using a venture capital tool. If you don't think you can get your revenue to that place, you better back down that valuation or you're going to kill your business.
Mm-hmm. Yeah, that's an excellent point.
So I'll pause there. I'm happy to go in tons of other directions. But
I'll be brief. I know we want to get to some Q&A potentially, but I was just jotting this down because I think I'm going to write a content piece on it. The market cares about two things: momentum and retention. If you have both, wonderful. If you have momentum, great, because there's a lot of companies out there that don't have momentum. I think what a lot of investors are looking at are like, man, the last 2 years were tough in terms of growth. We saw a lot of growth degradation. The comps were hard. Maybe you grew super well during COVID, but then, what's happened? Can you reignite momentum? Can you show me and can I believe, and can you show me indicators that momentum can reunite? New bookings, right? Maybe you've milked all the expansion out of your installed base of customers. Expansion revenue is great. Land and expand, negative churn, all the things David mentioned earlier. But at some point, you got to add new customers, right? And not even talking about the efficiency and CAC of adding those customers, but can you add new logos and new ARR? Number one, momentum. There's a lot of companies that don't have momentum. It's easier to have momentum the earlier you are because you're just working off of a lower base, and the growth rates are inherently higher as a result. Or retention. So if you don't have any momentum, you better have really, really good retention. Then you're kind of looking at, you're not a venture investable business, but maybe you're an add-on acquisition to some other asset that already has momentum, and you can be cross-sold into that asset. So you got to think of it from the perspective as well of the investor who's evaluating that opportunity. If it's a private equity investor with a platform that you can plug into and add some revenue and maybe some cash flow, great, or further enhance their momentum. So it's all very situational, but I think boiling it down to what's my momentum look like and how can I show that, and what's my retention look like and how can I show that?
Yeah, I love that. That's an excellent point. Should we move on to kind of the how? Like, how should companies be tracking this?
Sure.
So there's a number of tools out there for SaaS companies. There's things like Maxio, which is formerly known as SaaS Optics. People use spreadsheets. There's things for if you're doing a B2C or even B2B, but using Chartmogul or Profitwell or Stripe, things like that. Talk to maybe from your perspectives. What are some ways to track? What have you seen some best practices around that?
I can take that. So yeah, I think we segmented. You mentioned some of the names out there between, hey, are you selling software to SMBs and they're paying you on a credit card? If you are, there's relatively good metric tracking systems out there. The ones that you mentioned, Chartmogul and Profitwell, probably being the best at this point. And those are great. But oftentimes the case is maybe you're selling to SMB, mid-market, and enterprise, so only X% of your revenue is running through, a system that can plug in. So it's not giving you the full view of the business as someone who's looking for a full view of the business. It gets harder in enterprise software and above. Maxio is really good, formerly SaaS Optics. But beyond that, it's spreadsheets effectively for the most part. And that can be okay so long as you have a well-designed spreadsheet that you are adherent to and keep up to date and the math makes sense and all of that. So I think, if there's a tool to be used, I encourage people to explore using it. If there's not, for whatever reason, find someone such as a Dan or whomever that can help you build a spreadsheet that's really good and repeatable and that folks can digest and maintain. Not only external folks and stakeholders, but people within your team, the C-suite, department heads, whomever, because oftentimes you're going to have multiple people contributing to that own a metric and need to report on it.
Yeah. The problem with spreadsheets is they can have errors, they can have flaws, there could be things hard coded, things like that. Yep. I think it's a chance for me to give a quick plug to something that we've been working on for a while. Something we have a solution we've called Insights by Ascent CFO, and so this is we're using third-party tools. Once we take the time to really understand a business and go deep and help them understand their metrics as fractional CFOs, we're using tools like Power BI and Tableau and other tools to help create dashboards that give really good tracking around those metrics. So that can be viewed in real time. We're connecting to whatever the data sources are. And so I think, feel free to reach out, or build it yourself, or find a provider. But it's something we found as we've spent some time coaching clients and companies, how important it is to have a very good handle on your numbers and understand your metrics. That we've built out a team to create these dashboards and real-time tools. And so if you feel free to check out our website, we've got a link to it, and with some demos, so that's available to all. David, what are we missing?
I don't think you're missing. I don't think you're missing anything from the tools perspective. What I think is important to reinforce is the ability and the frequency of communicating metrics, right? And so one of the negatives that we see from a lot of founders is their fear of communicating metrics in real time or on an ongoing basis, either to existing investors or potential investors that they're starting relationships with. Right. And that fear of communication metrics is only going to get you into a hole. Right. Like any good investor, any good partner is going to know that things are not always awesome. Right. Like it's, if you're doing overall, something happens, like that's how businesses work. Like running a business is really just dealing with the next crisis. Right. And so crises are going to hit. And one of the things that really makes certain CEOs stand out from others is not only their grasp of their KPIs and their metrics, but their willingness and ability to communicate it on an ongoing basis to everyone that matters. And by everyone that matters, I don't just mean the internal team, I mean existing investors, right? Like we have several dashboards set up with some of our companies now where at any point we can log in and see where they are on their metrics.
Yep.
Right. Also prospective investors, right? Updates, telling a story. Remember, lines, not dots. If you're looking at potential investors, and you're giving them ongoing updates, and they can see that you are growing a business over time and you're doing it efficiently and intelligently, that provides a lot more interest from those investors in re-engaging
right
in your company. So there's a lot of great tools for communicating, right? Insights is amazing, Tableau, like even if it's just spreadsheets, like use what you have, but the key is get good at understanding and communicating it in a way that builds confidence both internally and externally, and tell a story. And that's really good marketing.
Mm-hmm. Yeah. Was it Mark Susser who first coined lines, not dots?
I think he might have. Yeah. I mean, we use that
Yeah.
term all the time because that's
Yeah.
basically how our whole business works. Right. But
yeah, I mean, it's the idea of talk to investors, have a casual, there's a lot of investors out there who are interested in having those early conversations, even long before you're ready to raise money. You start, I remember reading, I think it was Mark's blog post about this concept, and the idea of you say, here's what I'm planning to do. Here's what I think I'm going to do. Here's what I'm going to market. Here's what my growth rate's going to look like, and I expect it to happen. Talk to me a year later, and yeah, we did that, right? So they took a note. They said, yeah, you thought you were going to do this. You've done this. You gain credibility, and so you have those conversations over a period of time, and you gain, the investor gains confidence in you. You gain credibility with them. It can be really valuable.
Yep. Yeah, 100%. And it's a huge part of how we make investment decisions is do we feel like we've got trustworthy communications with the CEO and the founding team? Are they telling the right story, not some high level, like clouded story around how awesome they're going to be, but hey, here's the reality.
Be precise, not vague.
Yeah. Like, hey, this wasn't great last month. Here's what happened, but here's what we did as a result, and here's what we think is going to, like, that is a much more insightful and helpful conversation than, oh no, we're fine.
Yeah. Honesty and transparency, right?
Absolutely.
Yeah. No, that's an excellent point. Excellent. Brian, anything to add on this? And I think we've got a couple questions here in the chat.
No, some questions.
One question is, do I need to use all of these metrics to manage my business? I mean, we've talked about a whole bunch of metrics. So from a SaaS founder, is it important to, do you need to use all of these metrics? Do they all apply?
No, I say that because it's like, it's impossible. So what you need to do is to be able to communicate them, measure them, monitor them. If someone asks you, you don't want to be on the back foot. You want to be on the front foot. Yeah, okay, here's that. But let me tell you what we're really focused on moving this quarter. right? These metrics, right? We're comfortable with where LTV to CAC is, but we, really don't like our retention, whatever it may be. And so I think it's more so that, Dan. I think if you try to manage to all metrics, you're maybe not managing to any of them.
Right. Take the time to really understand what are those drivers.
Yeah, I would say it a little differently. I think it's important to understand and know all these metrics. The ones you're driving and managing to from a priority perspective depend on where you are in your business, right? And so, like, the worst thing a founder can do is when they're talking to an investor, someone is not know one of these numbers, right? And that immediately destroys confidence from the investor perspective. So you kind of do need to know all these, because any investor doing diligence will go through all these numbers.
Totally agree.
Right? So you absolutely need to know what they are. The way you think about growing your business is which of these metrics are you prioritizing and managing to and focusing on when, right? And understanding how the whole stack works together and understanding which levers. I talk a lot about levers, right? So which is the right lever to pull when in the scope of your business, right? So, okay, we know we've got good top of funnel, but our conversion is shit, or our churn is too high. So wait, if I've got good top of funnel and I can adjust the lever on the churn, that does significant things to my revenue right now, right? So that's the right lever to be focusing on. Once you figure that out, and now you need more top of funnel, like, so it really is all about which of these, knowing all of them, but deciding which ones you're going to focus on as an organization when, based on the stage of your business, and why you're focusing on those metrics when. And that's kind of the key. Like, one of the things I say is your to-do list will never get smaller, will only get bigger, right? So, like, you're never going to get everything done. So don't try and do everything. Try and focus on the things that matter the most, that you can influence the best, and keep everybody focused there. Right. So it's not like, even though you know what all these numbers are, it's not like everyone in your company should be focused on all these metrics at all times.
No, but without you don't know where to focus. If you don't have them.
So hopefully I made that clear.
Yeah,
no, that's awesome. I mean, it's an evolution, right? It's a dynamic or organic organism, your company, and it's going to evolve. It's going to change over time. And different metrics are going to more so determine your growth and what's going to and it's not just revenue growth, it's what's going to drive valuation. There's going to be times when your net retention is going to be more important than your just new ARR. It's going to evolve. So take the time as a founder to really understand what are the key pieces today that are going to drive to that next stage.
And know from the market as well. I mean, I can think of a company in our portfolio who knows very well and has heard from the market of equity investors, has heard it from whomever, gross retention. You got to get your gross retention up. We like a lot of other things about the business, but you got to figure out your gross retention. And now there's multiple inputs to gross retention to work on. But all right, message received. That's what I'm 100% focused on, because I know when I get my gross retention above 90 from wherever it is, things open up from a capital standpoint. Yeah, excellent.
Let's see what other questions we have here. One question is, why do I need a system to measure my metrics? I mean, if you've got a photographic memory, maybe you don't, right? But I think it's having that dashboard for all to see, all the stakeholders, and being able to drill down into that. I think it's again, spreadsheets work at certain stages, and it's fine. I just think that you want to be pretty cautious around that. Spreadsheets can be prone to errors. You gotta keep an eye around access, and error checking, things like that. So I think there's risk. Let's see here, another question. Got a couple coming in here. What, if any, adoption are we seeing in Power BI adoption or other tools for real-time reporting? We're definitely seeing adoption. We think that it's more and more, some of these tools are next generational, and having access to multiple systems is really valuable. So you're not just plugging into your Stripe or other tools. You've got a whole picture around your entire business, which I think is what's nice about Power BI and some of the other tools that we've been using for a while. Let's see. I don't know if we have a ton of other questions. Feel free to jump into the chat. I will give a quick shout out here, a little announcement. There is an event in Boulder for raising money for some nonprofits. It's called Unite to Fight. It's June 1st in Boulder. If you happen to be in this area at 5:30 p.m. Ascent CFO Solutions is a sponsor of the Blue Corner. And they've raised, the competitors have raised over $100,000 for each of their own charities. It's a pretty exciting night, a fun night. I've attended before. It's organized by the Corner Boxing Club. And David, you might have a little bit of experience with this, if I'm not mistaken.
I do. It's an amazing event. Not that we want to spend too much time plugging it, but if you've never seen a professional boxing event, this is USA Boxing sanctioned event. People are in an actual ring. And these are founders, entrepreneurs, executives that have trained for 6 months at least to do this event. It's super exciting. And I think over the course of since it started, they've raised about a little over $1 million for charity, right? So it's really an amazing thing. And so it's not only fun to do, but you should absolutely sponsor, get involved, donate, and then look at it as potentially participating next year, because I actually started this event in 2018 or 2019, I think, because I was building my company. I was in horrible shape. I was all in on the business. I couldn't move. I was overweight. My back was killing me. And I was literally about to be hospitalized because I couldn't move. And boxing kind of saved my life. And that's why we started the event. And it's just a great experience, and it's very exciting, and a great event for charity. So definitely participate.
Awesome. Thanks so much. Well, thanks everybody. Our contact information is here on the next slide. It looks like I can put folks in touch with Brian or David. It looks like we have only if you want to go to the next slide, Julia. We've got you can reach out to me at dan@ascentcfo.com. If you guys want to mention your email addresses, it looks like the slides may have gotten stuck here.
Yeah, just David at massive.vc.
Yeah, you can find me on LinkedIn, Brian Parks, CFA, or I'm at bparks@bigfootcap.com.
Awesome. Very good. Well, thanks everybody. Thanks for joining us. David and Brian, I really want to give you a huge thanks, really showing up today and providing some good information. I really appreciate it. And yeah, feel free to reach out to any of us with any questions, and hope you enjoyed it.
Our pleasure. Hope it was helpful, Dan. It's a lot of fun.
It was fantastic.
Appreciate you having us. Thanks, everyone.
Thanks. Is there a stop recording button, Julia?